Hello and welcome to the Red Wave Consulting Group LLC's Mergers and Acquisition meeting. On behalf of Michelle Donvu, my name is Jonathan Lopez, and we'll be discussing the acquisition of Allied Colloids by CIBA. The main objective of any company is to increase shareholder value, which stems from an efficient management and the company's performance in the market. When some companies are not performing well or the shareholders' value is not increased, takeovers are common. Mergers and acquisitions are a way to help increase shareholder value and also for a company to expand into a certain industry. This report is about the takeover of Allied Colloids that produced and exported pollution control chemicals for water treatments. Two companies that are discussed primarily in the takeover are Hercules Incorporated, based in the United States, and CIBA Incorporated, which is based in Switzerland. Now that we understand the major key players, what really caused Allied Colloids to become a takeover target? And there are several reasons, but one of the main reasons was that the company had a strong market share in a niche industry with a high margin, or at least it produced a high margin. And that really helped because Allied Colloids produced and exported pollution control chemicals, and these chemicals had a technology that was really considered attractive to others because it was very helpful through its water-soluble polymers used for water treatments. But although it was primarily made for water treatments, it actually was very beneficial to the textile and paper industries. And since this technology was so attractive, it also helped the industry have growth. So there really was a strong market share for the water treatment industry, which accounted for a majority of the company's business. Hercules itself would also have a better presence in Europe if it had acquired Allied Colloid because of its geographic location. And if Hercules was able to acquire them, then there would be really no competition for the technology, and the Aqualon resin operations in water-soluble polymers that Hercules had would actually become better and more efficient. In addition, CPS was also acquired by Allied Colloid in 1996, and this acquisition gives reasoning to Hercules to target them a little bit more aggressively because they've wanted to acquire CPS for years. And if Hercules was able to take over Allied Colloid, then they would actually also acquire CPS, which would expand the operations in the water treatment industry. Furthermore, specialty chemical companies in the UK were attractive to others because they were cutting costs. And because of this, Allied Colloid was also seen as attractive because they were cutting costs themselves. And since they were cutting costs, this would increase revenue, possibly increase margins, and with those increased margins, this could become a little bit more attractive for a takeover. And lastly, commonly when companies target other companies for a takeover, it's because of poor performance. And Allied Colloid had been performing below expectations for a number of years, and one of these reasons for the poor performance was the strengthening of the British pound. With the strengthening of the British pound and also rising raw material prices, Allied Colloid's share price was reflected poorly. And the chairman and chief executive for Hercules, Keith Elliott, also made note that the stock was underperforming the market by about 38% within the last 3 years. So you can see, gave good reason that the performance indicated that they were a primary takeover target. So as we heard before, Hercules would benefit very largely if they were able to acquire Allied Colloids. However, CIBA was actually the one that was able to acquire them. And one of the main reasons for this acquisition was because of the growth possibilities. So CIBA's profit margins were about 10% and prior to the merger, and actually the profit margins of Allied Colloids is about 19%. So an increase of the combination of them is what the main game plan is to kind of drive profit margins and increase revenue. And also, growth was a big factor in why CIBA considered the takeover. Allied Colloids invested heavily in their research and development, and with the focus on heavy innovation, CIBA could benefit by growing more with the improvements from R&D. Also, merging with Allied Colloids provided CIBA with a globalization strategy, and the merger would actually expand them into a new industry and a new market, thus improving their market position by incorporating the United Kingdom as well as Switzerland into their expansion. And financially, really an acquisition or merger would value CIBA through financial aspects, since CIBA would improve the debt-equity ratio as well as reduce their overall WACC. And CIBA at the time did not have much debt, and after acquiring Allied Colloids would help CIBA reach its target debt-to-equity ratio or optimal capital structure. So with increased leverage, lowering WACC, and reducing cost of capital, CIBA would then create more shareholder value. CIBA also valued the growth potential for merging as the financial growth, and it's discussed above, and it is apparent that CIBA would be able to expand their operations with Allied Colloids both geographically and by adding diversification with the addition of the specialty chemicals and increasing the operations within its water treatment division. The growth potential and the high value added products that CIBA would gaining or would be gaining would all follow back on the key objectives of the profitability growth, increased value to shareholders, and also expanding market reach and adding higher profit margins. Now that we understand CIBA's game plan as to how they were going to expect the acquisition to affect their balance sheet and their performance, let's see what actually happened. So we come to find out that the acquisition had a negative effect on CIBA's balance sheet and performance. And really, they acquired some great things. They acquired about 2 billion Swiss francs worth of intangible assets and goodwill, but that was actually all negated because the debt outweighed their actual current assets. And through this acquisition, their long-term debt actually increased by about 3.3 billion Swiss francs. And really, not only did this have an effect on assets and liabilities, but the shareholders' equity decreased overall by more than 24%. And we see that as about a 1 billion Swiss franc decrease. So the main cause for these decreases in equity is equity rooted from the write-off in process, research, and development. And by 1998, there was a decrease in retained earning from the one-time write-off. When there was a decrease in retained earnings, this could affect the earnings per share ratio, and CIBA did not issue additional equity, which resulted in a decrease in the earnings per share ratio since there was a decrease in value of retained earnings. So when there's normally an increase in your liabilities, there's an effect on your net worth. CIBA's net income was also affected by the acquisition. Net income decreased, and by 1998 there was a net loss of about 739 million Swiss francs, even with an increase in sales in that same year. And expenses also increased by about 11%, which was a majority from that actual acquisition. So similar to the balance sheet, CIBA's stock also declined after the acquisition. The stock price fell dramatically after the acquisition. Earnings per share slowly recovered through time from about 1998 to 2002, but the stock price never fully recovered. And the decrease in the stock price is actually a sign that the performance within the company also declined within the balance sheet. So in every negotiation or any deal that you do in business, there always has a feeling of a winner and a loser, and this is no different, especially in mergers and acquisitions. One person's getting taken over, one person's merging and trying to long-term benefit their growth and their revenue stream. So in this case, who won and who lost? First, we're going to go through the winners. One of the main winners from this acquisition was the shareholders of Allied Colloids, since CIBA paid a premium for shares that the company bought. And the share price for Allied Colloid actually increased from the bidding between Hercules and CIBA. So they kind of drove each other up because they were both trying to acquire this company. And really, another one would be the CEO of Allied Colloids, another winner. But it really depends on your point of view, because he could be considered a winner because he was given about 415,000 pounds from his shares in Allied Colloids, as well as been given a position with CIBA's post-acquisition. So he was given a job, he was given a premium. It's a pretty good deal, but some may also argue that he can be considered a loser because he resigned a year after in 1999, but he chose to resign, right? So, you got your bonus, you're out of there, awesome deal. And then next we're going to move on to the losers, and really the workers of Allied Colloid are going to be considered the losers from this acquisition, even though they were promised to have job security after the acquisition. Because a year after, so they make it a whole year, after, CIBA started a program that cut many of the employees of Allied Colloid out. And this program was called Skills Concentration. So if you're going to get into a skills concentration seminar, be wary, they may cut your job. And in fact, they cut about 1,000 jobs right after this seminar. Another loser from the acquisition will be Hercules. Hercules desperately wanted to acquire Allied Colloids for their technology, and it's really even been since when CPS was around, before Allied Colloids acquired CPS. Besides losing the bidding war for CPS, they also got outbid for Allied Colloids. So in the future, although if you really want something, maybe you need to pay the premium, and hopefully it is to your benefit. And then also, CIBA holds both a winning and losing position with the acquisition of Allied Colloids. In the short run, CIBA was negatively affected by the acquisition with negative performance. But a year after the acquisition, CIBA's rating was also in question by Moody's Investor Services. Moody's Investor Services reviewed CIBA to potentially downgrade the company, which would increase the cost of capital for CIBA, completely against the grain of what they were expecting and what they want. So although in the short run CIBA struggled and was considered a loser, in the long run CIBA can be considered a winner from the acquisition because they started a water and paper treatment division, which they previously did not have, and it's grown and benefited the company. CIBA also was able to retain material market share of the niche market that Allied Colloid was the leader of. Also in operation within the company was able to diversify, which increased net sales over time and increased leverage with the issuance of debt and decreasing the overall cost of capital. Definitely a win. In conclusion, since losing the bidding war for alloyed colloids, Hercules continued to decline in value, and in 1998, Hercules purchased Betts Dearborn and sold the company 3 years later to GM Specialty Materials. Hercules' share price also never recovered and continued to decline until about 2006 when it started to realize its gains. Morgan Stanley then downgraded the company, and the company was taken off many analyst recommendation lists. However, in 2007, Hercules received an award called the Presidential Green Chemistry Challenge Award for developing and commercializing a formaldehyde-free adhesive. Hercules was then acquired by Ashland Incorporated a year later for $3.3 billion. Congratulations, Hercules. After the acquisition for CIBA, CIBA's financial performance deteriorated and for a couple years, and then it was able to improve at the end of 1999. With the acquisition, CIBA had also acquired additional debt which outweighed the assets they had also acquired earlier from the acquisition. By 1999, CIBA had an increase in total assets and decrease in total liabilities. In addition, an increase in retained earnings helped improve shareholder equity for the company. After about 1999, CIBA started to slowly improve with improved net income and increase in earnings per share. However, in 2001, economic conditions caused CIBA to have a decrease again in its performance, and profits were not as improved. Then, however, by 2009, they had recovered substantially, and BASF acquired CIBA with the company, where the company acquired and integrated CIBA's activities into a performance product segment. So BASF bought CIBA for about $50 a share Swiss francs, which is a premium at the time. And after the acquisition, BASF had good business performance with strong earnings and increased efficiency.